today's report, the 9th of May 2025, right? So what's in store for us today? Right, today I want to share with you all this particular interesting title, Federal Reserve Signal Shifts, High Inflation and Unemployment Risk Delays Rate Cuts, right? Following its latest policy meeting, the Federal Reserve opted to hold interest rates steady, reinforcing a cautious tone amidst rising uncertainty in the economic outlook. While maintaining confidence in the overall resilience of the US economy, the Fed notably shifted its language to acknowledge increasing risk, specifically higher inflation and unemployment, casting doubt on the timing of unexpected rate cuts. Now, there is also a shift in language from optimism to caution. If you look at the Fed report, the most noticeable change in the Fed's communication came in the modification of its policy statement. Compared to March, new language was added emphasizing that the risk of higher unemployment and higher inflation have risen. Okay, so this is the latest one. Now, at the same time, prior language that implied steady progress and confidence in inflation falling, like uncertainty around the economic outlook has increased further, became more neutral and reserved as well. Moreover, the Fed announced that starting April, it would slow the pace of its balance sheet reduction by cutting treasury redemptions from 25 billion to 5 billion per month, while keeping mortgage-backed security redemptions unchanged at 35 billion. Now, this is a very, very big development right over here, because this is quite a huge reduction from 25 billion to 5 billion per month. So this marks a notable shift towards easing liquidity pressures. Okay, so the implication here is the Fed is becoming more concerned about downside risk and is slowing its tightening stance while staying away from signaling imminent rate cuts. So during the press conference, basically the wait and see mode dominated. So during the press conference, Chair Jerome Powell reinforced this cautious stance. All right, he stated that while inflation remains somewhat elevated and risks of higher unemployment are emerging, current data still shows a resilient economy with three things. Number one, solid growth despite the Q1 distortions. As you all know, there was a rush in imports, and that in a way distorted the GDP figures, right? So if you take that away, there's still solid growth. Number two, stable labor market. We have seen the previous non-farm payroll data coming in still quite healthily. And number three, inflation running slightly above 2%. Now, Powell made clear that while tariffs could push inflation higher temporarily and slow growth, the full impact is still very much uncertain. And he said the effects of inflation could be short-lived or persistent. Avoiding that outcome will depend on tariff effect and keeping inflation expectation anchored. Okay. He repeatedly stressed that the Fed's desire to wait and see, signaling patience and no rush towards rate cuts. So for future rate cuts, basically is pushed further out, right? Because during the March meeting, the Fed's Summary of Economic Projections, or the SEP, suggested 2 rate cuts this year. However, Powell was basically non-committal when asked whether those forecasts still held. He said, I wouldn't want to try to make a specific projection for where we are relative to that. We'll reassess in June, right? So market expectations quickly shifted following the press conference. According to the CME Fed Watch 2, here are the results. 79.9% chance of no rate cut in June, up sharply from 41.8% the previous week. This sharp reversals reflects the Fed's more cautious tone and unwillingness to commit to near-term easing. And this you can see from here. 41% 1 week ago, jump up to 79.9. Okay. So basically, the market had to react to this news. And here's the explanation to the reaction. Number one, although the Federal Reserve acknowledged that risks of higher inflation and unemployment have increased, the stock market reacted positively because the Fed ruled out further rate hikes and showed no urgency to cut rates immediately. This reassured investors that monetary policy would not tighten further, which reduced fears of a policy mistake that could harm growth. Additionally, the Fed's decision to slow the pace of its balance sheet reduction was seen as basically supportive. This means less liquidity will be drained from the system, which tends to help asset prices, including stocks. Finally, although rate cuts were not promised, the Fed left the possibility open for later in the year if economic condition worsens. This revived hopes that easier monetary policy could come in the future because financial markets looks ahead. Investors interpreted the current weakness in the economy as a sign that rate cuts may still arrive eventually, which would support stock prices. Now, you need to know that although the market did rise, it did not rise in a way that, it shows sign that, yeah, it's going to just fly off, going to the moon, because this kind of optimism comes with risk. Okay. The Fed made clear that inflation remains somewhat elevated and unemployment risks have risen. If inflation proves stickier than expected, or if unemployment rises sharply, the Fed may be forced to stay on hold much longer or even reconsider easing altogether. In that case, market expectations could quickly reverse, putting renewed pressure on stocks. Okay. So these are the things that you need to take into account. So with that, that's the report for today.